Welcome to my video presentation on the optimal capital structure. Okay, so I've read a lot of textbooks and there's just been a lot of inconsistencies that I've been trying to reconcile for some time now. And so what I would like to do in this video is show you a model that I came up with that kind of explains this. This is the adjusted present value model for comparing a levered firm which has some debt to an unlevered firm which is all equity financed. Unlevered means there's no debt. Levered means that the firm uses some form of debt financing. Now, if you borrow money, you pay interest expense on that debt, and that's an expense for the company on the income statement. Now, anything that's an expense lowers taxable income, and therefore lowers your taxes. So there's a side effect of debt financing, which is good, and that is that you save money on your taxes. You don't pay as much in taxes because you have a write-off, okay? The bad news is this part. The bad news is that the company, the more it borrows, the more likely it is that it will go bankrupt, and that's the bad news. Okay, so let's talk about some books that I have been looking at for a while. This one is Myers, the 10th edition of Myers Corporate Finance Textbook, one of the most popular finance textbooks in the country. Okay, and here is their three-step process for unlevering and relevering the WACC, as they call it. So the first thing they do is they estimate R, what I'm calling R sub U in my model, the unlevered cost of capital. They're calling that the opportunity cost of capital, and what they're doing is they're basically calculating the WACC, the weighted average cost of capital, but ignoring the tax rate. And then they're applying this formula from Miller-Modigliani proposition 2 to estimate the cost of equity, and then they recalculate the WACC. And there's a problem with this, and the problem is if you apply this model and you try it out with all sorts of numbers, you will see that the weighted average cost of capital continuously declines. Is that realistic? I don't think so. The realistic model would be where there's a perfect mixture of how much debt and how much equity a firm should use that would maximize the value of the firm. So the model presented in this textbook isn't going to give you this. It's not going to give you a WACC that has a minimum. In fact, it will just continuously decline as you add more and more debt. So why is that? Well, the problem is the Myers textbook just gives up on estimating the present value of the financial distress costs, and they're only focusing on the benefits of debt. So naturally, when the WACC falls, it continuously falls. What that means is the value of the firm is maximized with entirely debt financing. That's not realistic. So we need to take what we learned from Myers and maybe adjust it a little bit to make it more in line with reality. Here's another book that I've been using for quite some time. This is the McKinsey Valuation Textbook, 6th edition. And then the appendix in the back of the book, they give you 1, 2, 3, 4, 5, 6 different ways of figuring out the levered beta if you have the unlevered beta. So this is kind of confusing, and they all have different assumptions on how the tax shields are discounted, and is the debt risk-free, is it not risk-free? So which of these, if any, are kind of realistic? Well, that's kind of what this video is about. How do you lever and unlever beta? How do you figure out what your cost of capital is? How is this, how can we make this more realistic? Okay, and we're going to be looking at a bunch of different cases. Here is case 1, okay? This is the classic Miller-Modigliani argument in a hypothetical world with no taxes and no financial distress costs. So here is my model. To start off, we have the risk-free rate, the market risk premium, a tax rate. Notice I plugged in 0 for the tax rate because in the classic Miller-Modigliani proposition 1 and 2, without taxes and no financial distress costs, there's no taxes. Okay, so I've also zeroed out these two other things here that we'll be talking about later, which allows us to increase the how much debt the firm has. Okay, so what does this model say in case 1? Okay, in case 1, we can estimate the cost of equity using the capital asset pricing model. Now, the capital asset pricing model is a very popular model invented by William Sharpe and others, and they've won the Nobel Prize for this. And I'm just adjusting it for something that I'm calling the business risk premium, but that's just 0 for now, so we keep it consistent with the classic, equations that you would see in textbooks, which is just the capital asset pricing model is being used to estimate the cost of equity. Okay, now let's suppose that the firm itself finances itself with 20% 20% debt and 80% therefore in equity. Okay, and suppose that the debt is completely risk-free, so that they pay 4%. If the treasuries are paying 4%, this company pays 4%. Is that realistic? Probably not. But we'll modify this model a little bit and make it more in line with reality momentarily. The cost of equity again is 10.75. So then we apply the weighted average cost of capital over here, and that allows us to value a company. So here is a hypothetical company that lasts 4 years, and that's it. After year 4, the business is liquidated, and it's only going to be generating these 4 cash flows. Okay, if we discount these cash flows at the weighted average cost of capital, we have an estimated value of the business of 533.34. And over here, I have another way of estimating this same exact value of the business using this recursive formula right here. And what this says is the value at time t is equal to whatever the value is in t plus 1, so the following period, and the cash flow discounted by 1 plus r. So let me show you how this works. Remember, this is a very simple business that only lasts 4 years, so it will be liquidated, and that's it. So in year 5, there is no cash flows that the business will generate. It's over. So what is the business worth? 0. It's no longer going to be generating future free cash flows. But using the same exact formula, we grab the 2 values that we find here and we discount it back. That brings you back 1 period to year 3. So this recursively allows us to calculate the 533.34, and which is the same as we have here. Okay. Now, the adjusted present value method, what we're trying to do here is estimate the value of the unlevered firm, the tax benefits, saving money on our taxes, and the the potential bankruptcy costs using the adjusted present value method. Now, the way that works is we model the side effects of the financing side effects separately. Okay. Now, the weighted average cost of capital formula makes a very important assumption, which is the value, the firm itself is going to be financed in these proportions, 80-20. So, for example, over here we have the value of the business at time 0, which we know is 533. 20% of that is going to be financed with debt, and therefore 80% is going to be financed with equity. Over here we have the value of the business is 483. Again, 20% of that is the value of debt. Now, we can estimate the interest expense as what is the interest that we paid. Well, here's what we borrowed, and then we pay 4% of that back to the lenders, and so that's your interest expense. Interest tax shield. Interest tax shield is how much are you saving on your taxes due to this write-off that we have on the income statement due to the interest expense. Well, all that is we're just going to be taking the tax rate times the interest expense. There is a shortcut formula for estimating the interest tax shields, and that's what this is. What this is saying is you take the debt from the previous period times the interest rate that you pay on that debt. So beginning balance of debt times the interest rate on debt times the tax rate is the money that you're saving on your taxes. Notice that it's 0 because there are no taxes in case 1. The financial distress costs are 0. We'll get back to that in a moment and how I figured out how to estimate that. And what we're doing is we're going to be estimating the unlevered cost of capital using this formula down here. Now, the original Miller-Myers textbook just basically what did they say to do? We're going to be just doing like a WACC but without the tax rate, and that's essentially what this is because this firm is risk-free and there is no business risk premium. So this right here, the risk-free rate plus the business risk premium, is the same thing as the cost of debt in the Miller-Myers textbook. So right now, we are replicating the process that you would have in the Miller-Myers textbook for the unlevered cost of capital. I'm calling that R sub U. Okay, so we can estimate the value of the firm under all equity financing. It's a hypothetical. It's a present value of these cash flows. Okay, we add the present value of the tax savings due to interest expense, which are 0 because we don't have taxes. And then we subtract the negative side effects of, hey, you know what, if we borrow a lot of money, we might go bankrupt. Again, we're just assuming a perfect world with no financial distress costs with 0. So the value of the firm is 533.34, the same as we calculated up here using the WACC method. So that's case one. Now, what does this imply? What does this imply about the capital structure and the cost of equity and the cost of debt and all of this stuff? Here's what it basically assumes. If we plot the proportion of the capital structure that is debt, that's what this blue number is right there, on this axis, you can see what happens. We have an increasing function of the debt of the cost of equity, the cost of capital, the WACC, and the unlevered cost of capital, R sub U, are the same, and they're horizontal. It's independent of capital structure, and the cost of debt is linear. Now, what that means is, no matter how much we borrow, we always pay the risk-free rate. That doesn't seem very realistic, now does it? Okay, here is how you see the graphs in the Brilli and Myers textbook. What they do is, instead of plotting the weight and debt on the x-axis, they plot the debt-to-equity ratio. And if you do that, you actually end up with a linear function for the cost of equity. Okay, so it's going to be a straight line. Instead of being bendy like this, going upwards, it will look like a straight line. Okay, and what does this imply about the value of the firm? It's flat. So regardless of how much debt we use, the value of the firm is independent of capital structure. This is basically Miller-Modigliani Proposition 1 and Proposition 2 in a perfect world with no market frictions whatsoever and no taxes. Okay? Now, what we're going to be doing is now we're going to be looking at case 2. We're going to have no financial distress costs, but we're going to add taxes. So if we add a 40% tax rate here into our model, let's see what happens. Again, we choose to finance the business with 20% of debt and 80% equity, giving us a weighted average cost of capital, applying the standard weighted average cost of capital formula of 9.08%. If you discount the cash flows of the business at the weighted average cost of capital, we get 533.51. Here's the recursive model that just basically estimates the value of the firm at each individual point in time, which allows us to figure out how much of the company is financed with debt at each individual point in time by multiplying the firm value by the weight in debt. Okay, so we can estimate our interest expense, our interest tax shields, the unlevered cost of capital, and then we can apply the adjusted present value method, which takes the unlevered the value of the unlevered firm VU, assuming all equity financing. And the way that we do that is we discount the cash flows at the unlevered cost of capital. We add the present value, basically the tax savings due to the interest expense write-offs, and we're assuming that there is no financial distress costs. What is the value of the firm? 537.51, 537.51. So the adjusted present value method is consistent with the weighted average cost of capital method. But there's problems with this. What are we assuming? What we're assuming is if the firm is to borrow money for the very first time, they're borrowing just $1 for the very first time, they're going to pay the same rate as treasury bills. Is that realistic? Probably not. Businesses can't borrow and lend at the risk-free rate. Only the federal government can do such a thing. So naturally, the more realistic thing to say would be, hey, they're going to have a business risk premium, and we'll get back to that. Also, as the business borrows more and more money out of their capital structure, if they're financed primarily with debt, lenders are not going to be happy lending them the risk-free rate. They're going to charge a higher and higher and higher interest rate on this debt. So this is not realistic at this point where the cost of debt is just 4% and equal to the risk-free rate. Let's take a look at the charts and let's see what happens at this point. Okay, what ends up happening is the cost of equity increases. The cost of debt is a linear function. It's just independent of how much debt we use. It's completely unrealistic, and the weighted average cost of capital continuously declines. Now, whether we plot this with the weight in debt or the debt to equity ratio, just turns this blue line into a straight line, but that doesn't matter. I just want to show you these graphs. This is what you will see in a lot of textbooks, but if you plot this with the weight in debt, you get a bendy line. It doesn't matter, it's the same thing. But what does this imply about the value of the firm? Well, what that means is we're focusing on just these two parts. If you add debt to the capital structure, you are saving money on your taxes because of this write-off that debt provides. And we're assuming that there's no financial distress costs, so what is the firm to do? Well, in this fake made-up world, as you can see, as we use more and more and more and more debt, the value of the business goes up and the weighted average cost of capital decreases. So the conclusion is use all debt. And that is completely unrealistic. The optimal capital structure is all debt. Okay, so let's look at a world where there are financial distress costs, but there's no taxes, okay? So let's go back to our model, let's zero out taxes, and let's talk about how can we possibly add this financial distress costs into our model. So here are some refinements that I created. This is not standard. You won't find this in any other textbook. This is my creation. You don't have to agree with this, but I'm trying to make this as realistic as possible. Okay. First of all, let's assume that this business it will not be able to borrow at the risk-free rate, even if it has a AAA rating and it's a very safe business. They're going to have to pay, let's say, 0.5%. 0.5% more than Treasury. So if the company was to go and issue bonds for the very first time, just $1 of bonds, unrealistic, but whatever, they will never get 4%. They will have to pay a little bit more. No company can borrow and lend at the risk-free rate because we're not the federal government. So that's the first little adjustment to our model, okay? And what that does is it brings the cost of debt above the risk-free rate. So far that looks a little bit more realistic, but let's continue. It's also likely that lenders are going to charge a higher and higher interest rate as the company borrows more and more money. And a simple way to estimate that is this. We just take this green letter lambda times the debt to equity ratio. So let's say lambda is equal to 2%, 0.02. What happens is the debt to equity ratio, which is the weight in debt divided by 1 minus the weight in debt, because 1 minus the weight in debt is, of course, the weight in equity. So the debt to equity ratio times lambda is just one way to estimate the default risk premium. This is a non-standard equation, but it gets the job done. What it does is it creates this. It makes the default risk premium increase as the firm borrows more and more money. So what does that mean? What that means is the cost of debt can be decomposed into 3 distinct parts. There's a risk-free rate plus a business risk premium, because nobody can actually borrow at the risk-free rate like the federal government can. And depending on how much the firm borrows, the more and more the firm borrows, the lenders are going to charge a higher and higher spread on top of things. So that's what this last piece is. The combination of those 3 values gives us the cost of debt. So now that looks even more realistic. Let's take a look at the chart. As you can see, even if you have no debt in your capital structure, the firm still pays a little bit more than treasuries. That part makes sense. Also, as the firm uses more and more debt, we should see this line increase. Okay, it needs to be increasing. That's just reality. Also, the cost of equity should be increasing, and it should always be higher than the cost of debt. So far, our model looks pretty good. And we can see that the cost of capital, the unlevered cost of capital, is still a horizontal line, and we see that the WACC starts potentially to decrease, but then increase again. So let's take a look. Or no, I'm sorry, that did not work because we didn't have a tax rate in here. So yeah, that's right, because what we're trying to do is case 3 with no taxes. If you're in case 3 with no taxes, then the optimal capital structure is just no debt. As you can see here, the more and more debt we use, the value of the firm goes down and the WACC just continues to rise. So that doesn't make sense either, because we don't live in a world without taxes, okay? So case 3 is also not realistic. Case 4 is reality. Case 4 is with taxes and with financial distress costs. Okay, so let's add back the tax rate of 40% one more time. Okay, now let's take a look at the charts. Okay, again, the cost of debt starts above the risk-free rate, and it should be increasing as we use more and more debt. The weighted average cost of capital should come down and then go back up, so it has a minimum. The cost of equity is always going to be increasing with more and more debt. That makes sense. More risk, higher required return. And the unlevered cost of capital should be a horizontal line because it's independent of capital structure. It's a hypothetical. Now, here's the same graph with the debt to equity on the x-axis instead of the weight in debt. That just turns the blue line horizontal, or linear, I mean, but that doesn't matter. Let's just take a look at this last graph. Here we go. The minimum of the weighted average cost of capital occurs where the value of the firm is maximized, and that is more realistic. So how can we accomplish this, and what is the correct way to unlever and relever beta? Look at this look at these formulas from the McKinsey textbook on valuation. This is from the 6th edition. we have 6 different formulas for relevering and unlevering the beta, and they say, you know, this is also called the practitioner's formula. This one is the one that is used in Myers. Let's take a look. Let's see what we can do. All right, let's go back to our APV model. The APV model is considering now all 3 parts of this equation right here. The value of the levered firm is equal to the unlevered business plus the tax shields minus the present value of financial distress costs. Okay, so let's look at our APV. Here we have our interest expense again, and now we have tax shields. And look, we also have financial distress costs. Now here is how I am estimating that using simple common sense logic. Okay, if you had no debt in your capital structure, you would be charged 4.5%. But because you have some debt, we're at 20% debt, we pay 5%. So we're paying more interest on this debt than we would be paying had this company been, you know, if it didn't have any default risk premium. So that spread multiplied by the amount that we borrowed is basically the extra interest that we are paying attributed to the fact that lenders are charging us a higher and higher interest rate as we borrow more and more money. So that is how I'm estimating the financial distress costs, and it's baked into the spread between what would we be paying if we had no debt in our capital structure versus what we pay multiplied by the debt. So think of this as the extra interest that you have to pay in order to compensate the investors for the possibility of bankruptcy. And that makes sense, right? Okay, so let's talk about the value of the firm now. The value of the firm under all equity financing, we're still using the same formula that you see here, except the one in Myers, for the unlevered cost of capital, let's go back over here. What they do is they just do the cost of debt times the weight in debt. Well, if you do it this way, you will get this problem of a continuously declining WACC. So what I'm doing instead is I'm saying, look, if we are about to borrow our first penny for the very first time, we would be charged the risk-free rate plus the business risk premium, not the cost of debt, right? Because this is our first dollar or first penny. So that changes in the unlevered cost of capital formula, okay? And that, by the way, is going to cause the weighted average cost of capital to decrease and then increase again. Other assumptions that I'm making is that the interest tax shields, well, interest tax shields are only beneficial to the business if they have operating profits to shield from the IRS. So you can argue that the riskiness of the interest tax shields is the same as the overall underlying business itself. So the appropriate discount rate that I'm using here is R sub U, the unlevered cost of capital. So when we estimate the present value of the interest tax shields, we're discounting that at the unlevered cost of capital. Another assumption that I'm making is that the financial distress costs, again, what we're doing is we're estimating that as the spread, the extra interest that we pay due to the fact that lenders are charging a higher interest rate, that could also be discounted at the unlevered cost of capital. And the optimal capital structure is going to be the one that maximizes the value of the firm. It's a balancing act between the benefits of debt financing with the financial distress costs that debt brings about. So let's see what happens. The optimal capital structure, according to this graph, which you can see right over here, is around 30-something% debt, maybe 40% debt. That's where you minimize the WACC and you maximize the value of the business, maximize the value of the firm. Using these equations and models that we've come up with. Okay, so what did I say is the optimal? The optimal is 37. If I plug in 37, look what happens. The value of the business goes up to 532, and that is it. So that's how you can estimate the optimal capital structure. The optimal capital structure is the one that maximizes the value of the firm by balancing the good part of debt financing with the negatives. And you need some sort of a model. You don't have to use this one, but you need some sort of a model that ties together how much debt the company is using and how much more are they being charged on their debt. Okay, so that also has to hold. Okay, and it doesn't have to be this. It's in these other equations that you see on this spreadsheet here. Don't rely on this. This is just some way that I figured out how to make the cost of debt go up as we borrow more and more money. You could have also used a synthetic debt rating model or anything else that you find interesting. And the model will still work. It will still give you a minimum of a WACC and maximum of a firm value. Okay, so let's talk about the key, the grand finale, the summary here. What is the best way to unlever beta? Well, it turns out that what makes all of this stuff work and internally consistent with these graphs and common sense and logic, okay, is, you're not going to believe it, the practitioner's formula for levering and unlevering beta. Which means if you look at the 6 different formulas in the McKinsey textbook, it appears that the one that makes logical sense, according to our analysis today, is the easiest one to use. Yeah, who would have thought? Okay, let's go back to the model here. Also, when you're estimating the unlevered cost of capital, you could just take your levered beta, unlever it using this formula, plug it into the CAPM, and just add a business risk premium. How would you estimate the business risk premium for a company? Easy. You would look around in the marketplace and you would look for the poster child of a company that has a AAA rating and they have virtually no debt in their capital structure. How much more are they paying above treasuries? You can take that to be an estimate of the business risk premium. What about the unlevered cost of capital? Again, we could just use the risk-free rate plus the unlevered beta times the market risk premium. So this is applying the capital asset pricing model here. And then we add on that little business risk premium. And then the cost of equity, you could do this. This is what Myers does. And this is what I'm suggesting you do. If you do what Myers suggests, you will have a problem. You will have a continuously declining WACC, which makes no sense. Okay? But if you do this instead, where this part right here is essentially saying, hey, look, the value of the levered equity, not the value, but the required return is equal to the unlevered cost of capital plus the debt to equity ratio times the unlevered cost of capital. And then here's the difference between Myers and our model today, is that I'm not subtracting the cost of debt. The cost of debt and this piece right here, the risk-free rate and the business risk premium, would coincide if and only if we ignore this part of the adjusted present value valuation model. And I'm choosing not to ignore that because that's silly. Lenders require a higher interest rate as you borrow more because of the potential that you're going to go bankrupt. So it makes sense to model that as the extra interest you pay, as the extra interest that you pay times the extra spread times the amount of debt. Right. So what we're basically saying is the extra interest that you pay on the debt because of the fact that lenders require a higher interest rate. And that concludes everything we needed to talk about today. This is just a way to reconcile everything with reality, get a WACC curve that has a minimum where the firm value is maximized. We reconciled the fact that, look, businesses can't actually borrow at the risk-free rate. Even if they have no debt, they're going to have a higher interest rate than that. And I'm calling that the business risk premium. And then I came up with this little model right here for estimating the default risk premium, although you can use another model, such as a credit rating model based off of interest coverage ratios or whatever you want to use. The whole point is, this needs to go up as we use more debt in our capital structure. Taken together, if we plug in the default risk premium into the full equation, which says the cost of debt is the risk-free rate plus a little smidge plus the default risk premium, which depends on how much debt we have in our capital structure, you can kind of estimate that using this equation. Perhaps take some cross-sectional data on many firms and run a regression and estimate this model if you so choose. But I'm not going to do that right now. I'm just trying to show you a theoretical framework that could explain the adjusted present value method for valuing a business and how you can achieve the optimal capital structure that maximizes the value of the firm. All right, well, I hope you liked this presentation. Let me know your thoughts in the comments below, and have a wonderful day. Bye.